Hello, welcome to this week's Economy. I'm your host, Dr. Vance Ginn. Thank you for joining me. Remember, you can find all the show notes at vanceginn.substack.com or my website, vanceginn.com, where you could also request for me to be a speaker at one of your upcoming events or something else, or if you need a project done, I'm able to do that as well. So please check that out whenever you can. In other news, though, on the key parts that's happening here and what I discussed Friday, when this comes out, this week's Economy, I'm going to first tell you a little bit about what the Let People Prosper show had on Tuesday was Dr. Jay Bhattacharya. We talked a lot about COVID-19, the pandemic, what went well, what didn't go well, a lot of what didn't go well, and what the consequences are of that action. Please check that one out if you haven't already. The next Let People Prosper show that's coming out this coming Tuesday is going to be Dr. Alex Salter talking about his book, The Spirit of 76. We go into what it means, what classical liberalism was talked about a lot at that time, what the implications are for today, and so much more. So please check that one out as well. Share with your friends and family. It'll be much appreciated. So let's jump right into it. So I'm recording this on June 27th, 2023. So a couple of days before I normally do, as I'm going out of town soon for vacation. So, but right today, the Dow Jones Industrial Average was up about 0.6%, about 212 points to 33,926. The S&P 500 was up 1.1%, up about 50 points to 4,378. You also look at the crude oil futures, up $1.34 per barrel, or almost 2% of $68.03 per barrel. It's continuing to fall some here recently. You also see gold futures are down $10.50, which is about a 0.5% decline there. And you see the euro going up to $1.09 per euro, which is a depreciation of the dollar. So that's what we've seen here recently is some depreciation of the dollar. And it's kind of interesting that we're continuing to see that. But I think it's because of what we talked about before, where you have these interest rate spreads between different countries as the European Central Bank raises their interest rate here recently, and the Federal Reserve decided to pause on their interest rate. Well, that means that it's more affordable or more, you get a higher rate of return there than you will here. So you would rather have your money in Europe than you would in the United States. So that makes a lot of sense that we would see some depreciation there. That also raises the prices for a lot of our goods or contributes to higher prices here, because that means the dollar's depreciating, costing us more for imports from other countries, raising our prices, which can contribute to higher interest rates and inflation and everything else that we've already been talking about. One of the big mistakes I think that the Fed made was to take that pause. They should have kept raising rates, but more importantly, they should have been cutting their balance sheet, which is not being cut nearly as fast enough. And that's really what we'll see to cut the inflationary pressures that are out there. And speaking of inflationary pressures, there's a good article in the Wall Street Journal that came out today. U.S. home prices posted first annual decline since 2012 in April. And this is according to the S&P CoreLogic Case-Shiller National Price Index fell 0.2%. So the first time in 11 years. And this makes sense as we've seen interest rates soar. Mortgage rates have been soaring as well, up over a full percentage point just over last year, but substantially over it was just a couple of years ago before the Federal Reserve started to hike their interest rates. And interest rates would be even higher than that if the Federal Reserve sold off more of their balance sheet. Because remember, part of their balance sheet is mortgage-backed securities, which artificially creates lower mortgage rates throughout the economy. So I think this is something that we'll want to continue to watch as we move forward here. And when you look at some of these other measures, like Miami had the fastest annual home price growth in the country at 5.2%, followed by Chicago at 4.1%. The weakest market was Seattle, where prices fell 12.4% on an annual basis. If you also look at some of the other measures that are out there, the Case-Shiller 10-city home price index fell 1.2% over the year, and the 20-city index fell 1.7%. So I think you'll continue to see some of these declines over time. And even if you look at the median existing home price, it fell 3.1% in May from a year earlier to $396,100, according to the National Association of Realtors. And the 30-year fixed mortgage rate is now at 6.67%, and the week ended June 22nd, up from 5.81% a year earlier. So about 1 percentage point difference there. That's a large increase, and that raises the monthly amount of the monthly payments that are going to be made. And so in this sort of environment, you would expect declining demand, which we're seeing some of that. But at the same time, we've seen some slowing down of the production, the construction of homes, that might lead to a lower bound, a floor to how far home prices could go. Talked about that recently with Chuck Beecham on the Life Yield Prosper show, where his expectation was that home prices won't fall as much as they would during the Great Recession, which was down over 20%. They may not fall that much because of those lower bounds, the floor that's there. So that's something we really want to watch as we move forward. Another thing in the national news that came out today was that there was an article again in the Wall Street Journal, which is one of the journals that I read or websites that I read often. Ford plans to lay off at least 1,000 contract and salary workers. Cuts expected to significantly affect engineers in North America. And what's interesting about this is the very first paragraph, it says Ford Motors plans to lay off at least 1,000 salaried employees and contract workers in North America. People familiar with the matter said, the automaker's latest effort to defray the heavy cost of investing in electric cars. Again, this big push for energy or electric cars, to green energy, other approaches that are out there, ESG, environmental, social, government sort of issues are raising the cost on Americans. And a lot of it will end up being more moved to robotics, more moved to increase productivity from capital, physical capital compared to human capital, workers. And I think we're seeing more of that now. There is going to be a rising cost to what this is going to be over time. And this means it could cost workers not only for those particular businesses, but also across the economy as more people have to pay more and more for these endeavors. And look, I think we should be good stewards of the environment. I think God wants us to do that. It says it out clearly in the Bible. We should be good stewards of the environment and everything else. But at the same time, we've got to do it in a way that is efficient, in a way that also protects humans in the process. And I think the government putting its heavy hands in the direction of unreliable sources of energy like wind and solar, electric vehicles and the like, from tax credits and production tax credits and subsidies and everything else, is not the way to go. I believe that markets, the free market, will better handle those situations and allow us to have a more cleaner environment that's better suitable for humans over time. And that's what we've seen in places that have more free market capitalism over socialism or communism or something else, is that you have a better environment. The United States has actually been reducing its carbon emissions over time. And more importantly, its particulate matter that influences people's lives, their lungs, and everything else. And so I think we actually need more carbon emissions over time. I'm not one who comes out and says that this is killing off the planet and everything else. But we do need to be responsible for our environment as a whole. And that's really what's going to be important. And in fact, we breathe out carbon emissions all the time. So are we also going to have population control? I hope not. But again, I think it shows some of the cost of moving in this direction of this green energy agenda of electric cars and everything else, where Ford is having to lay off at least 1,000 workers. And I think we're going to see more of that in the months and years ahead. In other news on the state front, I wrote a piece for the Pelican Institute with my colleague, Jamie Teroff, about the big budget blowout that happened in Louisiana this session of this year, where there was just a massive amount of money that was being spent. It was just unheard of, this type of increase. And they had about a $3 billion surplus. And we were hoping that they would put some money into the rainy day fund, so that way there could be personal income tax cuts along with corporate franchise tax cuts. They ended up not doing the additional amount to hit those revenue triggers. And I've talked about this, I think, before, where revenue triggers I have some issues with because of this demand by the politicians to hit those revenue triggers instead of do what? Spend it. And instead, we should be focusing on spending restraint and using surplus dollars to buy down, different types of taxes, where the tax code in Louisiana is very complicated, with a progressive marginal income tax system, a progressive corporate income tax system, a corporate franchise tax, an inventory tax, just tons of taxes that it disincentivize people to work, to live, and raise a family in Louisiana. This is unfortunate. And I'm the chief economist at Pelican Institute, so I do a lot of work there. And what you see is this fiscal year 24 budget is $51 billion, setting a new record. And they even increased their spending limits for fiscal year 23 and fiscal year 24. In fact, they busted those spending limits and raised them substantially to where you see large increases from year to year, much more than what would have been expected from their already pretty ineffective and weak spending limit that's there. And there's a ton of money that's being spent in certain areas, $505 million to the Department of Transportation, $147 million to the Coastal Protection and Restoration Authority, $193 million to higher education institutions. $288 million to K through 12 and early childhood education, and over $700 million in new recurring spending was added to the fiscal year 24 budget that will need to be continued in future years, including the addition of more than 100 new employees and at least 5 new programs. Just a massive amount of money. And there was a lot of corporate welfare that was going on, other sort of expenditures that shouldn't happen. There were some good things like paying down debt for teachers and Louisiana employees. I think that's a good part of what was in the budget, but no tax relief. There was Senate Bill 1 that did provide some, but there was already a revenue trigger for the corporate franchise tax. This kind of doubles down on that, which is good, but they really need to find a better way to get this down as quick as possible. And then when you compare it to the responsible Louisiana budget the Pelican Institute put out, which just increases appropriations of state effort, which excludes any sort of dedicated funds of federal funds that happened underneath the last couple of bills that came out, like ARPA and all those things. You know, the recommended responsible budget went from $20.6 billion in fiscal year 23 to $21.4 billion. So it was about an $800 million increase. But when you look at the actual budget that was passed, was a $23.8 billion budget in state effort. So this was an increase by 15.6%. instead of the 4.1% increase in population growth plus inflation, which is the responsible Louisiana budget is based on. And so that means that spending appropriations in this case is $2.4 billion higher than the average taxpayer's ability to pay. This is just massive amount. And again, nothing going towards tax relief. So while this is happening, we need to come up with a comeback story that the Pelican Institute is talking so much about, and it is the need because people are fleeing Louisiana. It's a great place, and we need to make sure that this doesn't happen. And I'm hopeful that we can get some of these opportunities to do this soon. I've also released the Louisiana economic situation, where there has been some improvements, and I'll put some links to this in the show notes page. But again, when you're looking at the average weekly earnings, they're continuing to decline in most industries. The only one that's above inflation right now is for manufacturing. The other one that's up is education and health services, but it's still below inflation, meaning the real wages are continuing to fall. But other industries like construction, trade, transportation, utilities, financial activities, professional business services, continuing to see their average weekly earnings going down. So even further down when you take away inflation. It's a massive cost here, and it's something that really needs to change with this comeback story of tax reform, spending restraint, and regulatory reform in the process. Because right now, Louisiana has the second worst poverty rate in the nation, and this has got to change quickly. I've also got a new post up about the Texas economic situation. Texas, on the other hand, contrary to Louisiana, is a leader in job creation over the last year, and it has been since February of 2020, where you continue to see more jobs being created. This was the 20th straight month of total non-farm jobs increases. And when you look at the average weekly earnings for different industries in Texas, there have been construction that's well above inflation. Manufacturing is above inflation. But again, all the other industries, total private is below inflation, meaning real wages are continuing to fall. Professional business services going down. So while Texas is having a lot of job creation, the people who have the job are not able to keep with inflation that's all around them, which is growing at about 4% over the last year. So there's some concerns that are there that really need to be looked at and continue to be checked out before we see more opportunities to let people prosper. So with that, that's giving a good overview of the national, state economies that's happening right now. I'm hopeful that this was helpful for you and for others. Please go and rate this, subscribe wherever you get your podcast, and share it with others around you. And until next time, let people prosper.